Hi, welcome to my channel. My name is Gil Rossi, investor and funds manager. Today I want to share with you my analysis of Adobe. First of all, let me show you the structure I will use. It's divided in two parts. The qualitative analysis is past performance of the business, management, competitive advantages, and financial position. And once I am happy that all these four are met, then I go and analyze the quantitative portion, which includes projections and calculation of fair value and internal rate of return. So let's get started. Let's go to past performance. Let me go through the different segments classification. Adobe Creative Cloud groups applications and services oriented to content creation with popular software like Photoshop, Illustrator, Acrobat, and Premiere Pro. They also have the Adobe Document Cloud with all services around Acrobat software and the PDF format that the company invented. Together, these two conform what the company calls digital media. Then they have Adobe Experience Cloud, which contains all services related to marketing and advertising tools and solutions for marketing officers. This segment is called Digital Experience. And then they have the smallest segment, which is publishing and advertising. If we see the revenue mix among these segments, we can see that digital media is the largest and slowly growing in importance, 69% in 2019, 72% in 2020, and 73% in the most recent quarter. The second largest is digital experience, which represents around 24% of sales. And lastly, publishing and advertising, which are losing importance from 6% to 3% recently. In 2009, Adobe entered the digital experience business with the acquisition of Omniture. In 2013, it was called digital marketing. That year annual report, they explained that opportunity. Delivering the best experience to a consumer at a given moment requires the right combination of data, insights, and content. As businesses make this move to digital, our market opportunity is accelerating as consumers look for vendors to help them navigate this transition. Adobe targets this opportunity by providing comprehensive solutions that include analytics, social marketing, etc., and they deliver them through a broad set of solutions like Adobe Analytics, Adobe Target, Adobe Social, etc. These are applications we can find in the graph that I showed you before here, and also we can find here Marketo and Workfront, which are later acquisitions in the digital experience arena. Adobe believes that there are synergies between the digital media and the digital experiences, or digital marketing as they called it then. They say by combining the creativity of our digital media business with the science of our digital marketing business, we help our customers to more efficiently and effectively make, manage, measure, and monetize their content across every channel. In the last quarterly report, they discuss the business further, and they say digital transformation has become imperative for businesses of every size in every industry. Experience Cloud is the most comprehensive solution for content commerce, data insights, etc., and Adobe Experience Platform is the clear platform of choice for enterprises. So I wanted to share with you a view of this part of the business that is not very well known, that they have been adding since 2009 with the acquisition of Omniture, as I told you. And it's been a business that has not been grown organically. It has grown through acquisitions. So Adobe here is not the clear leader. There's competition from Oracle and Salesforce.com and many other companies which are large and with lots of capabilities. But I think it's going to be room for everybody, and this is going to be a big driver of growth for the next 10 years, I think. We can see in this graph revenue growing 3 times in the past decade, 13.2% on the compounded annual growth rate, and growth has been picking up in the second half of the decade with the digital transformation of the economy. Digital media is still a large part of the business. It grew at 13%, and digital experience has been also growing quite nicely at 14.4%. We can see in this chart the last quarterly results of 2021. Revenue grew 23% year over year, and digital media 25%. And then digital experiences grew 21%, and within digital experiences the subscription portion grew at 25% year over year. So we can see there has been a nice acceleration across all these important segments. Within digital media, Creative Cloud grew 24% year over year, and documents grew 30% year over year. And within documents, Adobe Sign saw impressive ARR growth of 40%. ARR means annual recurring revenue, and it is a forecast of the revenue they are expecting from recurring sources in the next 12 months. So I see this document cloud business with Adobe and the PDF as in the center of it as a very exciting one for the next 10 years. I think there's going to be lots of growth here. The documentation industry is changing. The way we handle and the way we manage the documentation. For example, there's lots of room to change in the shipping industry, in the financial sector, in the legal industry. Adobe believes that this is a 150 billion industry. They are only a very small part today, 1.5 billion. So there's lots of room to grow there. Let's see the income statement for the past 10 years in a graphical form. Here we have the revenue, which we just saw, and it grew at 13.2%. This is the gross profit, and we can see here how small cost of goods sold is for the company, meaning the direct costs to produce the services that they sell. This is the operating profit, which grew at 15.1% over the past 10 years on an annual basis, and the difference with gross profit includes indirect costs like selling and administrative, marketing and research and development. And this one here is the EBITDA, which is operating profit plus depreciation and amortization, grew at 14.6% on a compounded annual growth rate. And this is the gross margin, which has been hovering around 80%, and the operating margin, which is now around 30%. It has improved dramatically since 2014. 2013 was the year that the company was transitioning from a perpetual fee system to a software as a service. And so let me show you some comments from the quarterly releases back then in 2012 and 2013. The initial transition to the cloud exceeds our targets, they were saying in the second quarter of 2012. In the third quarter of 2012, they were saying, during the quarter, the company drove faster adoption of Creative Cloud subscriptions than originally projected. And here, the explanation of why the dip in the revenues during the migration to subscription model. They say revenue is recognized over time rather than at the time of purchase. And of course, what happens is that this delays revenue during that transition. And here in the fourth quarter of 2012, talking about the migration to subscription model, this will yield to stronger, more predictable recurring revenue model with higher long-term revenue growth. Adoption of Creative Cloud accelerated. This is a comment from the first quarter of 2013. And in the third quarter of 2013, our customers are overwhelmingly choosing subscriptions instead of the perpetual model license, which is accelerating our business. The CFO mentioned also that 41% of the revenue was subscription already. And finally, at the end of the fiscal year 2013, they raised long-term revenue growth rates with a compounded annual growth rate of 20% from 2014 to 2016. They later achieved those goals. I see lots of benefits in the subscription model, the software as a service one, because it's beneficial for the company and it's beneficial for the consumer. For the company, it can have much better visibility of the revenue and it can control piracy. For the consumer, it's a cheaper option. You can get regular updates, so you have a better service, and it's also gives you more flexibility. You can have lots of different options. So I think that it's a business that is going to make the digital cloud grow even faster than what has been growing in the past. Let's now check the cash flow statement. The operating cash flow in blue grew at 15.7% and the free cash flow at 16.6%. You can see how little capital is necessary to run this business, the difference between free cash flow and operating cash flow. And this one here is the capital expenditure as a percentage of revenue. It has been around 3% for the past 5 years. Operating performance, we see great returns here. The 5-year averages are double digits, improving in the second half of the decade, and they went through a dip around 2013 and 2014 when the company transitioned to a software as a service model, and this is the result of the revenue recognition that we mentioned, but nothing intrinsically wrong with the business at that time. Other than in that period, return on invested capital has been higher than weighted average cost of capital. And the good thing is that the difference is widening in recent years. The company operating margin is great at 33%. It's the highest it has ever been in the past decade. And I think that the transformation to subscription model and the transformation to the digital economy are both beneficial for Adobe, and hence the results we see in the margins and returns. We know that the improvement of operation results is mainly coming from the reduction in marketing and general and administrative, and not due to research and development spending cuts, which is a particularly good thing. So that concludes the portion of past performance. I am really happy with past performance. I think that there's a good base for the company to perform very well in the next 10 years, similarly to what they have been doing in the past 10. So now let's move to management. Adobe CEO, Mr. Narayan, has been in the position since 2007. He led the transformation of the company from desktop to cloud, which started around 2014, and has led Adobe into a new business area, which is digital experiences. That expansion began with the company's acquisition of Omniture in 2009. A few quotes from the CEO letter of 2020. Adobe's mission is to change the world through digital experiences. That has proved to be more relevant than ever. Today, every industry is experiencing a tectonic shift towards all things digital at an unprecedented pace. Content is fueling the global economy with new devices, channels, and modalities, leading to an explosion of content creation and consumption. Let's go to my list of points I analyze in management: capital allocation, compensation aligned with shareholders, stock ownership by insiders, dividend policy, and a long-term vision. Let's go to capital allocation. In this graph, we see the return on invested capital versus the weighted average cost of capital. You can see that the return on invested capital has been very strong most of the decade, except for the period between 2013 and 2015, when it fell below weighted average cost of capital. But there is a very good explanation for this. The company was transitioning from a perennial license structure to a software as a service one. I already explained this when we covered past performance. But what I want to note also here is that this demonstrates long-term vision from management, because moving from perennial license to software as a service is painful in the short term, but it was the right thing to do for the long term, I think. And thanks to that, Adobe is in an unbeatable position to benefit from the transformation to digital today. In this graph, we see that the return on invested capital has improved dramatically in the recent years, and I think this is a consequence of the software as a service model being better than perennial license at so many levels. Another good capital allocation skill we see is the way they use cash to repurchase stock. They have been buying back stock as the main way to return cash to shareholders, and the prices that they have been paying have been great, showing good capital allocation skills. The other way they use cash is by acquiring businesses. Adobe has been a very active acquirer, 52 acquisitions in its history. The first one was Photoshop in 1995, which was a great acquisition. And acquisition have mostly been bolt-on acquisitions. Some large ones here and there, but mostly bolt-on, and especially lately they are a bit larger. Here we have the last 4 acquisitions, 3 of them large: Magento for 1.6 billion, Marketo for 4.7, and the latest Workfront the leading work management platform for marketers, for 1.5 billion. All of them were paid in cash, which shows a savvy management not paying with stock when they feel their stock is undervalued. And the large acquisitions are in the area of digital experience, where Adobe has been growing the business through acquisitions mainly. The only one in digital media was the Algorithmic, which was a smaller one. And here we see the past 10 years acquisitions. Mostly they have been in digital experience. We can also see share buybacks have been quite large in the last 4 to 5 years. So these are the acquisitions they made each of these years. Cash has been accumulating lately, so there may be more acquisitions and or buybacks in the future. Now to compensation aligned with shareholders. The board is mostly paid in stock, and they have a requirement to hold 10 times the annual retainer in stocks. Last year, the board revised the executive compensation, reducing the goals set initially due to the COVID-mandated lockdowns. They reduced GAAP revenue target from 96% to 60% and non-GAAP EPS from 95% to 80%. I think this type of privileges for only a bunch of executives, when they have really good compensation, I think that they could have, bared the situation a little bit more, and there was no need for reducing the hurdles that they need to meet. And in fact, the year came to be one of the best years of the company, if not the best year of the company, and the hurdles stayed very low. Maybe I am missing something, but I really don't like this type of actions. Approximately 92% of the CEO compensation is equity-based, performance and restricted stocks, and 70% based on long-term relative total shareholder return versus the Nasdaq 100. They need to achieve at least 50th percentile to get the full intended compensation. The base salary is very reasonable, as you can see here. Cash incentive is overly complicated, as it happens with most companies that engage the services of compensation advisors, which of course must prove its fees are worth the delivering of very complex compensation packages. I am not a big fan of cash incentives, and I'm not a big fan of complex cash incentives. This is how the equity compensation is structured. One part is in restricted stock units, vested over a few years, and the other is in performance shares that depend on the 3-year percentile rank of the total shareholder return versus the Nasdaq that I mentioned a minute ago. They follow this formula, which is depicted in this graph. If Adobe achieves a median return in line with Nasdaq, or that means a 50th percentile, then management gets 100% of stock awards. That is the target award. And then it increases and decreases along this line, with a limit at the top and a drop to zero if results are below the 25th percentile. And if Adobe gets an average total shareholder return, executives should not receive target of 100% of their compensation. They should get less than that, I think, because in essence they haven't created value over the Nasdaq, their relative benchmark. But the compensation advisor may know differently, and of course, this is just a comment. And because executives keep stock that they get awarded, their compensation increases as the stock price increases. So it ends up being much larger than initially intended. For example, here you can see the green bar is the actual compensation, and the blue is the initial one. And I think this is good because it increases the alignment between shareholders and executives. So now let's see stock ownership by insiders. Here we can see the CEO, Mr. Narayan, owns approximately 182 million worth of stock, which is 182 times his base salary, and his requirement is to hold 20 times base salary. He is the second largest shareholder after one of the founders, Mr. Warnock, which has 200 million worth in stock. Let's move to dividend policy. Adobe has never paid a dividend, and I think they don't intend to pay one. Even if they have great cash flow generation, they prefer to return cash via buybacks. I really like the way that they are returning cash to shareholders. You know that I am a big fan of buybacks, especially and only when they buy them at decent prices. That has been the case with Adobe. I don't like dividends because I don't think they are an efficient way to return cash to shareholders. There's lots of bunch of reasons why I think that way, and probably this is material for a video in itself in the future. And lastly, long-term vision. I think they have been running Adobe with the long-term in mind, and the good example of this is the move to software as a service. That was painful in the short term, but it was a good long-term decision. So that concludes my analysis of management. Let's now go to competitive advantages. I think Adobe has competitive advantages normally found in great and large software companies. Large customer base that allows for network effects and high switching costs, and lastly, a great brand and technology edge. Let's start with the customer base. The main source of income of the business is the Creative Cloud, which includes Photoshop, Premiere Pro, Illustrator, After Effects, etc. My estimation is that there are around 33 million subscribers to the Creative Cloud. If you are using one of these products, for example Photoshop, you are most probably attracted to use the others since they work better and it would be cheaper. So the applications have a network effect among them because each one makes the others more valuable and vice versa. There is also a similar synergy with Adobe Document Cloud applications. If you are using Document Cloud, and there were 300 billion PDF documents opened in 2020, it is very probable that you use also Creative Cloud and vice versa because of the same reasons I just explained: cheaper and better experience. These two ecosystems have a large customer base of users that attract students to learn how to use these applications and universities to offer programs and degrees related. The larger the customer base, the more students and universities, and that makes the customer base grow. Same thing happens with companies. The larger the customer base, the more sense it makes for companies to use these products because the available workforce is larger, so they also grow the customer base. And then companies also are attracted by the new working force coming out of universities with expertise on Adobe products. So all this creates a large network effect. The large customer base, which improves with the network effect, creates high switching costs to those already in the ecosystem, and switching costs improve the network effect as well. So I think that the Creative Cloud has a really very enduring competitive advantages, not only in switching costs but also in network effect. We have similar advantages in the digital experience business, although not as large as the Creative Cloud in my view, at least for the time being. But if you think about it, the large customer base of Creative Cloud and the network effects and switching costs that they have spills over to digital experience. So digital experience is more valuable because digital media is there and vice versa. Let me show you the recent quarter highlights from the company. They talk about key customer wins like with ByteDance, Netflix, Microsoft and Unity, which are the companies that we just talked about in the network diagram we made a minute ago. And also they are saying that they have new partnerships to inspire the next generation of creators, including with Netflix and with the Khan Academy. And this is the other link that we saw in the diagram with the students and the universities. And lastly, they mention strong growth for Adobe Stock, which is a content library that contributors create and get paid when someone uses it, similar to the application store system for Apple and for Android. So I see also network effects here. If you think about it, the more stock available, the more attractive for customers and the more attractive for contributors to create content. So this creates a virtuous loop. And lastly, intangible assets. They have great technology. They are great innovators. They have been showing it since 1995, and they have a great brand. Photoshop, Premiere Pro, Adobe are all brands that are really recognizable. The PDF format was invented by the company. So I am very happy with the competitive advantages of the company. Let's now move to financial position. This is the assets. This is cash and short-term investments for November 27, 2020, the last fiscal year. And this is more detailed. And here we can see this is the cash and this is the short-term investments. And we can see that it's mostly in money market funds. So the cash, it's really 800 million, the one necessary to run the business, I think. And here we have the liabilities. There's no short-term debt. This is long-term debt, and this is operating lease obligations. So 4.6 billion. If we see now the last quarter, the figures are pretty much the same as in November 27, 2020. If we see how debt is distributed, we have here the interest rates that they are getting, which are quite reasonable and quite competitive. And this is an investment grade company, so it gets very good financial terms. And this is mostly in bonds up to 2030. So I think that they are in a great financial position. They have more cash than debt, so no problem there. So let's go to the projections. This is the revenues past 10 years. This is the future 10 years. As we discussed, they have grown at 13.2% the revenues, and my assumptions is that it's going to grow 13.9% the next 10 years. And my revenue assumptions are this: for digital media, 20% growth, going down to 10. For digital experience, starting at 20 and then 8. And for publishing, from 0 to 5. So all these growths per year will give me these revenues for each of the segments and this total, which ends up at 13.9%. And if you see here, the CEO was saying that they plan to surpass 15 billion in fiscal year 21, and my assumptions are 15.3, so they are quite similar. And they were expecting to have a 147 billion addressable market in 2023, and my assumptions is that they are making a 21 billion revenue, which is less than 20%. Let me show you this couple of graphs with subscribers here and with ARR here for the Creative Cloud. The subscribers, I have made a calculation. Up to here they gave us the subscribers to the cloud or Creative Cloud, and then my assumptions are that they have been growing, and this is the 33 million that I showed you in the competitive advantages, and this is the way they have been growing. At the beginning they grew quite fast in this axis, and this is a quarterly growth. So 50% here, for example, in August 13 means 200% per year. And it has been coming down and plateauing around 5%, but 5% quarterly growth is amazingly high. It's a 20% per year. And what's nice here is that the subscribers, even though most of the customers that were using the perennial fee structure have transferred into the cloud now and the subscription model, they still have a 20% increase in subscribers. So that means they are acquiring new customers that were not within Adobe before. This is really good. And here, if you see the annual recurring revenues for the Creative Cloud, this is a figure that they give us on a quarterly basis, and it has been growing non-stop. It's almost 10 billion lately, and this is the growth here in a quarterly basis as well. And you see here also it's around 5%, so growing at a 20% per year, which is great. Here we have the operating income of the past, and I'm going to base on this one to forecast the operating income, and I'm going to base my gross margin coming from digital media, digital experience, and publishing, similar to the figures that they have had before. They have been quite stable. And then in terms of the operating expenses, I'm using similar figures. This was quite stable as well, the research and development. So I'm using 17% and going up to 18 here. Sales and marketing in percentage of total revenue has been coming down. You can see here from 32 to 28. So what I'm doing here is I'm bringing it down from 28 to 25. And general and administrative, I'm doing similar reduction from 8 to 7. And this I'm keeping the same, the amortization of intangibles. So that gives me an operating income of this and an operating margin of this, which is 32%, going up to 37, improving, coming from 30 something, which similar to the past. And then with this operating income, I can get the EBITDA, adding back depreciation and amortization, and this gives me EBITDA. This is the number that I'm going to use for valuation purposes later, the one in November 2030. So now let's go to the income statement in projections, and these are my projections, and this is the EBITDA from 5 billion to 20, the one I showed you a minute ago. Now let's see free cash flow, which is the other metric I use. This is the past 10 years, and this is my assumptions, and they are based mainly on growth of operating cash flow starting at 15 and then going to 10 within the 10 years. And this gives me an operating cash flow of 12.4% growth in the decade, which is smaller than what they grew the past decade. I am using capital expenditures based on 3% versus revenue and going to 2.8. Lately, they have been in the 3% mark here, so I'm happy using 3%. This gives me the free cash flow. Operating cash flow, I deduct the capital expenditures and gives me this number. So this is the number that I'm going to keep in mind, 17 billion, which is in November 2030, which I'm going to use for valuation purposes. So here we are in the fair value calculation. We have the EBITDA that we mentioned and the free cash flow. With these two, I'm going to use these two ratios to calculate enterprise value. In EBITDA, I'm using 22. And this is, if you see EBITDA, enterprise value to EBITDA for the last 10 years, normally it has been much higher than 22, even double 22, but I'm going to be conservative. And in terms of free cash flow, 25 means these assumptions. From 2031 to 2040, this growth in free cash flow, and this is the weighted average cost of capital I'm using. And this is the growth in perpetuity from 2040 onwards. So that gives me 25. And this is what I'm using. So what I do here is I compute the enterprise value. Then I subtract the debt, which is very small here, and gives me market capitalization estimated for 2030. With the weighted average shares outstanding of 439,000, which I am computing this way, from the 495 going down at 1% per year to 439, and is similar to what the slope has been in the past. And so with these two figures, I get the price, and I use an average of the two. 1,000 is my average target price for 2030. With that, I have a cash flow. This is the price I'm paying to buy the stock. This is the free cash flow per share I'm getting during the 10 years I'm going to hold this stock, and this is the price I'm going to get when I sell it. This free cash flow per share is the free cash flow per share, but adjusted. I deduct the buybacks because they are already incorporated here in the per share. And I also deduct the stock compensation to executives. So this is the remaining portion of the free cash flow. With that, I can get an 8.91% internal rate of return for this cash flow, buying at this price. If I buy at a cheaper price, you can see here, if I buy at 460 to 480, I will be getting roughly 10%, which is my aim. Normally I try to get 10%, but in a world of 1%, 2% yields for the 10-year treasury, 10% is really high, but it's something I normally try to aim. So this would be my fair value, roughly somewhere here, 489. If you're happy getting close to 9%, which is a very good return, I think, for a company like Adobe, that if you hold it long term is going to be not a high risk investment, you can buy it at the current price. I think that today the price is even higher than this because it has been going up slightly. So that concludes my evaluation and analysis of Adobe. I hope you like it. As you can see, it's a very nice company, a company that I like. It is not really cheap, but I think it is fairly valued, and it's a good investment if you have 10 years to invest. As you know, I like to write the value creation of a business, and this one for sure is going to be much more valuable in 10 years. And so I hope you like the video. Please give it a like if you do, and subscribe to the channel. And if you want to get alerted, ring the bell. And I hope to see you next time for another evaluation video, probably in a couple of weeks. Thanks very much for watching. See you then. Bye bye.